Manish Mehta, the Managing Director of Investments and Co-CIO at Samara Capital, joins us on the show right now. Manish, hi, so great to be speaking with you. Thanks so much for making time. I'll just start by the conversation by taking a leaf out of the earlier conversation that Nikunj was having with Timothy Moore of Goldman. He was talking about how last year a lot of PE players were complaining about too little money, or actually too much capital chasing too few ideas. Has that corrected now?
Yeah, good afternoon, everyone, and good to be on the channel. Certainly there has been, a lot of capital that came in over the last couple of years, but we are seeing an equally large amount of demand for that capital coming in, particularly for a mid-market buyout investor like ourselves. We are seeing an increasing number of promoters looking to monetize and diversify their wealth. We are looking at many large conglomerates looking to divest their non-core businesses. And most importantly, we are now beginning to see an opportunity into tapping into public markets, into listed space, where we do see a large number of listed companies that may not be as liquid. So someone like us can come in and potentially take a controlling stake and do an intervention to make it more attractive for the general public investors. So from a demand side, also we are seeing an increasing number of potential opportunities, which should be very interesting in our opinion.
All right. Hi, Manish. This is Shrishti also joining in. Yes, indeed, we have seen that IPO frenzy in the markets, especially from some of these PE firms also making a way to that, planning to take an exit. But talk to us about what are the key opportunities that 2025 could throw for the PE firms, which are the segments that are having the most traction right now?
Yeah, so certainly, what we are seeing essentially is a lot of uncertainty, like with the changes happening globally, and particularly in the US, there is market is uncertain into what's going to happen, what's going to change, and uncertainty leads to a lot of opportunities invariably. So we are on the lookout across sectors. There are sectors that are obviously have been in high demand, like the healthcare consumer is always in high demand. But when we look at opportunities, we look at medium term. We don't look at what's going to happen over the next year or so. We look at medium to long term. What's the prospect of a sector in the next 5 to 7 years? And many times, what we do observe is that people price in those opportunities. So if, say, a real estate cycle is on the upswing, we do know that technology is going to play an increasingly big role. So what we'll observe is that the key businesses in those sectors will already be priced in. So when we look at opportunities, we look at what are the derivative sectors that will benefit out of these long-term trends. And we find opportunities in defensible businesses in these derivative sectors to be more attractive, rather than going after the core sectors, which might seem attractive in the mid to short term.
That's a smart way to play it. Perhaps that ways you can get out of some crowded trades and focus on the ones which can be the domino effect plays or the second, third tier impact names. But to the earlier point that we were talking about, you said that the demand and the opportunity has increased for you to deploy capital as well. But has the valuation corrected now in that sense? Because we were seeing those rounds happening in multiples of each other, and of course, then IPO happening at much higher levels. Has that come to a bit of a semblance now in terms of pricing?
Yes, certainly there are pockets, like if you, so there will always be, cycles in almost all sectors that you can think of. And when you look at some of the sectors which are highly rated and I think driven backwards from what the capital markets are trading at, so you would, invariably, even we'll find it very hard to find a deal at an attractive multiple in those sectors. But then there will be many other sectors or sub-sectors that will be out of demand or out of sync of the cycle, and but good long-term structural opportunities. So we try and find opportunities in those sectors in times like these. So we are very value-oriented. We are fairly disciplined in terms of our entry price, and we try not to chase what sort of is the flavor of the day, and try to find opportunities which are maybe counter-cyclical or, as I mentioned, more derivative to the core sectors that are the beneficiaries.
So Manish, with this, why don't you spot some of the sectors or highlight some of the sectors for us, like you were just sharing your ideology while deploying the capital in terms where you see the growth forecast, or you try to predict the growth forecast maybe for the next 5 to 7 years. But talking about India, there's a lot we talk about the renewable space, a lot that we talk about the energy transition. So at this point in time, which are the sectors that are finding the most of the traction from the PE investors?
The multiple, I think, as I mentioned, there are these mid to long-term structural tailwinds. We know that certain sectors will move in one direction. So just to, build up on your example. So for instance, we do know that the power and energy demand is going to go up as more electrification happens, more industrialization happens, more data centers come in because of technology. So we'll try and find sectors which are indirect beneficiaries of the power and energy. So we'll not directly invest in say a power plant, for instance, which in our opinion is not for us. We look for more capital efficient businesses. But there are multiple other, secondary and tertiary ways you can play on the increasing long-term demand for power and energy. So that's one way. Similarly, on technology, if you look at it's very obvious is that technology is going to play increasingly bigger role in all our lives, going forward. Indian technology, to a large extent, historically has been an export story. But what we are observing now is the development of domestic tech demand, like various tech services and products that are growing as the digital infrastructure gets built up in the country. So we are spending a lot of time finding potential opportunities in tech or tech sector, largely defined, not narrowly on the services side, but where are opportunities which are not the typical, services or, software export, but something that may be, catering to domestic demand and riding on the digital infrastructure that's getting built. So these are the kind of plays, we sort of look at. For instance, we did a deal that's a derivative on manufacturing growth in the country. So we do know that there is a development of infrastructure and manufacturing coming into the country. So we looked at sectors that will be derivative beneficiaries. So one thing that came to our mind was insurance. And as more assets get built up, they need to be insured. And we looked at the long and deep into the value chain of insurance businesses. Yeah. And we realized that in our opinion, the best way to play is possibly to look at an insurance broking business. So we spent some time and recently did a deal in that sector. So that just as an example of finding derivative ways to play.
All right, Manish. All right, Manish, that's great chatting with you. We are a little squeezed on time, but thank you so much for taking the time out and speaking with us and helping us understand what's actually playing within the PE space and what could we expect from 2025.
If you like this video, then like, share and subscribe to ET Now.